The recovery has gained momentum despite the pandemic and the war. On the other hand, inflation has steeply increased much beyond the upper tolerance level. A large part of the rise in inflation is primarily attributed to a series of supply shocks which can be linked to the war. In these circumstances, we have started a gradual and orderly withdrawal of extraordinary accommodation instituted during the pandemic, that is the COVID-19 pandemic. Similar to our resolute and timely actions to limit the economic damage emanating from the COVID-19 pandemic, the Reserve Bank will continue to be proactive and decisive in mitigating the fallout of the ongoing geopolitical crisis on our economy. We have already reprioritized our policies to control inflation without losing sight of the growth requirements. Our approach underscores a commitment to move towards normal monetary conditions in a calibrated manner, and our steps will be measured. We will remain focused on bringing down inflation closer to the target and fostering macroeconomic stability. Let me now focus on the decisions and deliberations of the Monetary Policy Committee meetings, the meeting which we had recently. Against this background, the Monetary Policy Committee, that is MPC, met on 6th, 7th and 8th of June, and based on an assessment of the macroeconomic situation and the outlook, the MPC voted unanimously to increase the policy repo rate by 50 basis points to 4.90% with immediate effect. Consequently, the standing deposit facility, that is the SDF rate, stands adjusted to 4.65%, and the marginal standing facility, that is the MSF rate and bank rate, to 5.15%. The MPC also decided unanimously to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. Let me now explain the MPC's rationale for its decisions on the policy rate and the stance. The protracted war in Europe and the accompanying sanctions have kept global commodity prices elevated, and this is across the board. This is exerting sustained upward pressure on consumer price inflation well beyond the targets in most of the economies. The ongoing war is also turning out to be a dampener for global trade and growth. The faster pace of monetary policy normalization undertaken by systemic advanced economies, that is AEs, is leading to heightened volatility in global financial markets. This is reflected in sharp corrections in major equity markets, sizable swings in sovereign bond yields, US dollar appreciations, capital outflows from EMEs, and even from some advanced economies. The EMEs are also witnessing depreciation of their currencies. Global stagflation concerns are growing and are amplifying the volatility in global financial markets. This is feeding back into the real economy and further clouding the overall outlook. The MPC noted that in such challenging global environment, domestic economic activity is gaining traction, while inflation pressures have intensified further. The upside risks to inflation, as highlighted in the April and May 2022 policies of the MPC, have materialized earlier than anticipated, both in terms of timing and magnitude. Inflationary pressures have become broad-based and remain largely driven by adverse supply shocks. There are growing signs of a higher pass-through of input costs to selling prices. The MPC noted that inflation is likely to remain above the upper tolerance band of 6% through the first 3 quarters of the current financial year, that is 22-23. In this context, supply-side measures taken by the government in reducing excise duties on petrol and diesel, along with other measures, would help in mitigating the inflationary pressures to some extent. The MPC also recognized that sustained high inflation could unhinge inflation expectations and trigger second round effects. The MPC therefore judged that further monetary policy measures are necessary to anchor the inflation expectations. Accordingly, the MPC decided to increase the policy repo rate by 50 basis points to 4.9%. The MPC also decided to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. It may be noted in this context that the repo rate still remains below its pre-pandemic level. I would now like to provide an assessment, a more detailed assessment of growth and inflation. And first, I would like to take up growth. According to the provisional estimates released by the National Statistical Office, that is NSO, on May 31st, India's gross domestic product, that is GDP growth, in 21-22 is estimated at 8.7%. This level of real GDP in 21-22 has exceeded the pre-pandemic, that is the 2019-20 level. On the supply side, major categories also surpassed the 2019-20 level. Available information for April and May indicates that the recovery in domestic economic activity remains firm, with growth impulses getting increasingly broad-based. Manufacturing and services purchasing managers indices, that is the PMI, for May point towards further expansion of activity. This is also corroborated by movements in railway freight and port traffic, domestic air traffic, GST collections, steel consumption, cement production, and bank credit. While urban demand is recovering, rural demand is gradually improving. The contact-intensive services related to trade, hotels, and transport have recovered in Q4 of 21-22. Going by the early results of our surveys, capacity utilization in the manufacturing sector increased further to 74.5% in the fourth quarter of 21-22 from 72.4% in Q3 of 21-22. So that is in the last financial year 21-22, between Q3 and Q4, the capacity utilization in the manufacturing sector increased from 72.4 to 74.5%. Capacity utilization is also likely to increase further in the current financial year. Investment activity is thus expected to strengthen, driven by rising capacity utilization, government's capital expenditure, and deleveraged corporate balance sheets. Improvement in investment activity is also reflected in pickup in demand for bank credit and persisting growth in imports of capital goods. Merchandise exports have remained buoyant with double-digit growth for the 15th successive month in May this year, while high growth of non-oil, non-gold imports is indicative of recovery in domestic demand conditions. Looking ahead, real GDP is expected to broadly evolve on the lines of the April MPC resolution. The forecast of normal southwest monsoon should boost kharif sowing and agricultural output. This will support rural consumption. The rebound in contact-intensive services is expected to sustain urban consumption. Our surveys suggest further improvement in consumer confidence and households' optimism for the outlook a year ahead. Business sentiment remains upbeat according to early results of our surveys. Nevertheless, the negative spillovers from geopolitical tensions, elevated international commodity prices, rising
तो यहाँ
input
पर
cost,
आरबीआई ने जो फैसला किया है वो प्रेस कॉन्फ्रेंस में आप सुन रहे हैं। रेपो रेट बढ़ा दिया गया है। रेपो रेट में 50 बेसिस पॉइंट की वृद्धि की गई है, जो बढ़कर अब 4.9% हो गया है। सीधा सीधा मतलब यह है कि जिन लोगों की भी ईएमआई है, यानी कि चाहे जिसने भी होम लोन ले रखा है, कार लोन ले रखा है या किसी भी तरह का लोन है, तो वो ईएमआई अब बढ़ जाएगी। और यहां पर साफ तौर पर बताया गया है कि देश में जो बढ़ती हुई महंगाई है उसको रोकने के लिए आरबीआई ने अर्थव्यवस्था में इस क्रेडिट फ्लो को नियंत्रित करने के लिए अपनी इस पॉलिसी में रेपो रेट को बढ़ा दिया है।
जय, दर्शकों के लिए थोड़ा सा आम लोगों की भाषा में समझा देते हैं कि रेपो रेट वो चीज है जिसमें बैंक को जिस रेट पे कर्ज दिया जाता है,
जो आरबीआई देता है, बिल्कुल।
जब आरबीआई से बैंक को लोन जो पैसा है वो ज्यादा रेट पे मिलेगा तो उसका बोझ वो आम लोगों पर डालते हैं। तो भले ही नौकरी ना मिली हो, आपकी सैलरी ना बढ़ी हो, महंगाई बढ़ती जा रही है, अब आपकी ईएमआई भी बढ़ेगी, यानी जेब में एक और बड़ा छेद आपके होने वाला है।